Hello students, welcome to the review session on accounting for joint ventures. Okay, so before we start the review of the questions that you've taken for your test, I'll just tell you in brief about what accounting for joint venture. I'll just give you an overview of this chapter. Okay, what kind of questions are typically asked in the exam. See, joint venture is nothing but a temporary arrangement. Okay, it's like a temporary partnership where two or more individuals, they come together, they decide to carry on a business for a definite period. It's not like a company which is a going concern. Okay, so this is only for a specific period. They contribute capital, they contribute goods, okay, and they carry on the business. They incur expenses, they make sales, there is a profit or loss on the venture, they distribute the profit or loss in the agreed ratio, and the joint venture comes to an end. Okay, so as I told you, joint venture is nothing but coming together of two or more individuals in order to carry on a certain business. Okay, so it is like a temporary partnership. So the main characteristics that we have to keep in mind when we account for joint ventures is that, first of all, it is not a going concern. Okay, so it is not going to exist for perpetuity, just like in case of a company. Okay, or in case of any other business, we generally assume it is a going concern. That is why we use the accrual concept. We continue to show the assets at cost. Okay, so why do we do all this? It's because we know that it's going to exist for the foreseeable future. But in case of joint venture, we know that it's going to be there only for a particular. For example, let's say during the Diwali season, two or three people get together and they decide to do a cracker business. So obviously the business is going to last for 7 days, maximum 15 days, right? And let us say two or three underwriters, they decide to underwrite a public issue of shares, right? So again, so that is a temporary business. Let us say two or three individuals decide to construct a building, right? So uh, the partnership or this arrangement is going to exist till the building is going to be constructed. So it is a temporary partnership, right? So as far as accounting is concerned, we need to keep in mind need to keep in mind is that joint venture is not a going concern. There is no act whatsoever that governs a joint venture. There is no necessity to execute a legal agreement. Okay, so it can be just an oral agreement between the co-venturers, right? So I'll introduce a new term here, co-venturers. Just as when two or more people decide to form a partnership firm, they are called partners. When two or more individuals decide to enter into a joint venture, they are called co-venturers. Okay, and so it's really simple. The accounting is really simple, really logical, and so the third thing that we know that the first thing that we need to keep in mind is that, first of all, it's not a going concern. There is no act that governs joint venture uh, transactions or joint venture relationships. Third is that there is no distinction between capital expenditure and revenue expenditure. Okay, so that distinction between capital and revenue expenditure arises only when we know that an expenditure that we have incurred is going to be useful for more than one accounting period. Since here the periodicity concept itself is not there because it's not a going concern, the distinction between capital expenditure and revenue expenditure is redundant. So, even if an asset is purchased, it is treated as a normal expenditure. Even if you incur some expenses, say traveling expenses, conveyance expenses, cartage, okay, transportation expenses, all those expenses will also be treated as a normal expenditure only, right? So there's no distinction between capital expenditure and revenue expenditure as far as joint venture is concerned, right? So what happens is, let's say A and B are co-venturers, they decide to enter into a joint venture, right? A contributes some capital, B contributes some capital. A contributes some goods out of his own stock, B contributes his own goods out of his own stock, and they all, with the existing cash, they make some purchases, they incur some expenses, then they get income from this joint venture business. So we know that it's a business, so obviously they want to earn profit. So we'll find out the profit from the so it's nothing but income minus expenses. That's all. One new thing here is that sometimes what happens is at the end of the joint venture, there'll be some stock left, or some um, asset is left. Okay, so that asset or that stock can be taken over by one of the co-venturers at an agreed value. So that the value at which the asset is taken over, that is the stock is taken over, or the fixed asset, or strictly we cannot call it a fixed asset because the distinction I told you is not relevant here. Okay, but for your understanding I'm using that term. Okay, so if that is exists at the end of the joint venture, then one of the co-venturers may take it over at an agreed value. That should be taken into account while we calculate the joint venture profit or loss, right? So with respect to your exam, there can be two types of questions, right? Or rather we can say three types of questions. First question is where they'll test you on the concepts relating to joint venture, right? The second type of question will be computational questions. When we come to computational questions, there can be two types. One question will ask you to find out the profit or loss in the joint venture. Very simple, all incomes minus expenses, but we need to keep in our mind the value at which the asset or the stock is being taken over by one of the co-venturers. I'll tell you how it is to be done when we come to such problems. The second type of computational question is where they'll ask you to find out how much money one co-venturer has to remit to the other co-venturer. For example, let us say that A and B are co-venturers. A makes all the purchases, he incurs all the expenses, and B is responsible for making the sales. So B makes the sales and he collects the money from his customers, and so here B has to remit A's share. Okay, so the question will ask you how much money one party is supposed to remit to the other party, right? So in order to solve these questions, we need to understand the different methods that are used in order to account for joint venture transactions. There are broadly three methods of accounting for joint venture transactions. Okay, the first method is where separate set of books of accounts is maintained. Okay, so I told you there are three methods of maintaining accounts for joint venture. Any one of these methods can be followed. Okay, whatever method you do, even in your exam, even any method you follow, the answer will be the same. Okay, but depending upon the size of the joint venture, I'm saying practically speaking, depending upon the size of the joint venture, depending upon the ability, or depending upon the agreement between the co-venturers with respect to maintenance of accounts, okay, any one of these three methods can be used. The first method is where separate set of books of accounts is maintained. Generally, this method is used where the size of the joint venture is high. Okay, is big, not high, big. Okay, so here this is just like partnership accounts where we maintain a separate bank account. There is something called a joint bank account that is maintained. There is a joint venture account, and the third account is the co-venturers account. Okay, so joint bank account, we know, is nothing but a bank account that is opened separately for the purpose of transacting the uh, business, or rather transacting the cash transactions of the JV. So all the transactions relating to the JV will be routed through this joint bank account. So at the end we will know how much balance is there in the joint bank account. The next account I told you is the joint venture account. This joint venture account is the nominal account. So the moment I say joint venture account, you must think of it like it is a profit and loss account. Okay, so profit and loss account, we list out all the expenses on the debit side, all the incomes on the credit side. We don't prepare a trading account here, it's not necessary. So we prepare only a joint venture account, which is the nominal account, which will tell you what is the profit or loss in the JV. The next account is the co-venturers account. Co-venturers account will trace all the transactions that have been made by the co-venturers. For example, if A and B have entered into a JV, A contributes 1 lakh rupees, B contributes 80,000 rupees. They have deposited this in a particular account that is designated for the purpose of joint venture. The entry will be joint bank account debit to A's account to B's account. So in a joint bank account, it is an asset, so it increases. So we write to A to B 1,80,000, and in the co-venturers account, we will credit the accounts. Okay. So suppose say A makes some purchases, right? So then what will happen? A's account will get debited and the joint bank account will get credited because money is going out, right? So JV account will get debited, JV account will get debited and joint bank account will get credited because this purchase is an expense, it gets routed through the JV. So that is the first method where separate books of accounts is maintained. The second method is where what happens is each co-venturer will record all the transactions relating to the JV. For example, if A and B are co-venturers, A in his books of accounts will record all the transactions made by him, made by the other co-venturer B in his books of accounts, and B in his books of accounts will record all the transactions relating to the JV, his own transactions and transactions made by A also. Okay, so let us see in the books of A will maintain a JV account and he will open B account, right? In the JV account, as we told you, JV account is a nominal account. So that will give us the profit or loss made in the JV. And all the transactions that affect B will be routed through B's account. Okay, so this B's account will tell us all the transactions that B has incurred, and it will also tell us finally whether amount is to be received from B or whether amount is to be paid to B. Let us say, for example, A and B are co-venturers, right? And A has supplied goods from his own stock worth rupees 10,000 into the JV. B has supplied goods worth 20,000 rupees into the JV from his stock. That's the transaction given to us, right? So 10,000 plus 20,000 is the total stock that has come into the JV. So the entry that A will pass in his books is JV account debit 30,000 to purchases, because it is out of his purchases, it is going into the JV. So two purchases 10,000 and B is contributing 20,000 into the JV. So A will credit B in his books to B 20,000 rupees. So what will B do in his books? Okay, so B will debit JV account debit 30,000. Two purchases, B will credit 20,000 because he has contributed 20,000 rupees from his stock. So he will credit purchases 20,000 and he will credit A with 10,000. So likewise for every transaction such entries will be passed. Okay, right? And finally, as I told you, the profit or loss will be known from the JV account, and B's account in A's books and A's account in B's books will reflect the money to be exchanged between these two co-venturers, right? The third method is where each co-venturer records his own transactions in his books. Okay, he does not record the other person's transactions in his books, right? But now you might think, how is it possible to find out the profit or loss if you don't record the other person's transactions? See, strictly speaking, in some way they record for all the transactions. I'll tell you how. Okay, see, let us take the same example. A and B are co-venturers. Now A in his books will uh, open two accounts. One is called the memorandum JV account. Okay, and he'll open another account which is called JV with B account. Okay, and B will open two accounts. One is called the memorandum JV account, and he'll open another account which is called JV with A account. Okay, so memorandum JV account is a memorandum. So whenever the term memorandum is attached to a particular account, I'm sorry, whenever the term memorandum is attached to a particular account, it means that it's strictly not part of the double entry system of accounting. Okay, so the memorandum JV account is nothing but an account which just lists out all the incomes on the credit side and all the expenses on the debit side, and it finally tells us what is a profit or loss. Okay, and JV with B account in the books of A will record only A's transactions and his share of profit in the JV. The balancing figure in JV with B account will tell us the money that A has to receive from B or A has to pay B. Similar entries will be passed in the books of B. He will open a memorandum JV account. That memorandum JV account will record all the transactions and give us the profit or loss, and he'll open an account called JV with A account, and he will record only his transactions. B will record only his transactions in that account, and finally we will know how much money B has to pay A or B has to receive from A. Okay, right. So another thing is, we will not record any bad debts or depreciation. Obviously there is not going to be any depreciation of assets. If there is a fall in the value of asset, that will not be recorded in the JV account. And another thing that we have to keep in mind is, suppose there is a loss due to fire, right? That loss will not be recorded anywhere. Okay, suppose, let us say, goods worth rupees 10,000 are lost due to fire, and the insurance company admits 80% of the loss as claim. So only that 8,000 rupees will appear on the credit side of the JV account. So this is what we have to keep in mind. Right? So with this introduction, I will go through the questions. Right, let's look at the first question. Which of the following statements is true? Right. See, I'll give you a small tip. When you are tackling such questions, true or false questions, what you must do is read the first option and mark whether it's true or false next to it. T, 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 whatever it is. T, F, T, T, whatever it is. Okay. So, so that it will be easy for you to eliminate finally. What happens is, sometimes these questions get so confusing that by the time you come to the last option, you do not know what you decided for the first option. So read every option carefully, make up your mind whether it's true or false, and write T or F next to it. Right? So we look at the first option. There is no difference between joint venture and partnership. It's false. There is I told you, joint venture, it's only a temporary partnership. It is strictly not a partnership, because partnership is governed by an act. Okay, Indian Partnership Act of 1932 governs partnership firms, but there is no such act that governs a joint venture. It's only a partnership in the sense that two or more people come together and they decide to do a business, share the profits, and that's it. They part. So A is false. Consignment in joint venture is the same, not at all. That's false. In case of joint venture, none of the acts is applicable. Yes, that is a true statement. In case of joint venture, the number of related parties is only one. No. Right? So the answer is C. Next, which of the following statements is true? Only one venturer bears the risk. It's false. The risk is borne equally. right? Both of them bear the risk. Only one venturer can sell the goods. No, it depends on the agreement. Both of them can sell, one can purchase. It depends on the agreement or the arrangement that exists between the co-venturers. Only one venturer can purchase the goods. Again, this is not true. In joint venture, the provisions of the Partnership Act do not apply, right? So that is a true statement. So answer is D. Next, which of the following statements is not true? Which means we are looking for the false statement. Joint venture follows accrual basis of accounting but does not follow going concern. That is true. Okay. Next, joint venture is different from partnership and consignment. That is true. Co-venturers share the profit in agreed ratio. That is true. Suppose in your problem they do not mention the ratio in which the co-venturers have agreed to share the profits. It means they are going to share equally. A joint venture legal deed is to be drafted before forming joint venture. No. So D is the false statement. Next. For recording own share of profit in case of memorandum JV method. Okay. Okay, so this is the third method I was talking about, where you record for only your transactions, right? Only your transactions will be recorded in your books. So there's a memorandum JV account, and then there is another account which is JV with the other co-venturer, JV with B. In the books of A, if A and B are co-venturers, in the books of A will maintain a memorandum JV account, and there will be another account which is called JV with B. So to record A share of profit we will know from the memorandum JV account, but the entry that A will pass will be JV with B account to P&L account. Okay, so as I told you, a memorandum JV account is not part of the double entry, so there won't be any double entry. It's just like a statement which is prepared in the form of an account, that's all. Okay, so JV with the other co-venturers account is debited and P&L account is credited. So answer is D. Next, loss of uninsured goods. Yeah, this is what I told you. When suppose there are goods of 10,000 rupees, they are lost, and insurance, there is no insurance, so it's a loss, right? So you don't record it anywhere, so it is not recorded in the JV account at all. Next, bad debts incurred on account of joint venture sales. No, it is not recorded anywhere, right? So answer to this is also D. It's not recorded in the joint venture account, right? Cost of goods lost by fire is 5,000. Insurance company paid a claim of 80%. In this case, the joint venture account, yes. So here, goods lost by fire is 5,000. We are getting a claim of 80%, okay? So 80% of 5,000 is 4,000 rupees, and your JV account will be credited. So whatever you are getting will be credited to the JV account. Entry will be bank account debit to JV. Okay, it will be credited with 4,000 rupees. Next, discount charges of rupees 1,000 on discounting a bill receivable by one of the co-venturers maintaining all joint venture transactions in his books of account will be. Okay, so here discounting charges, for example, let us say A and B are co-venturers, right? And A is drawing a bill on B, and B accepts the bill. A goes to the bank, he discounts it, and obviously the bank is going to charge some discounting charges for it. So the discounting charges is an expense to the JV. Okay, so that will be debited to the joint venture account. Next, there are two co-venturers, X and Y. X is recording all joint venture transactions in his books of accounts. Discount charges on discounting a bill receivable accepted by Y will be debited to. Okay, so again, this is okay, so whatever it is, whether he is in the previous question we saw that they are recording, each one is recording all the transactions in their books of account. whatever it is, whether they record for all the transactions, whether they maintain separate books of accounts, or whether each one records his own transactions, whatever it is, the discounting charges is an expense and has to be debited to the joint venture account. Okay. Next, X. Okay, there are two co-venturers, X and Y. X is recording and they're recording their own joint venture transactions in their respective books of account. In the books of X, discount charges on discounting a bill receivable accepted by Y. Okay, right. See, this is an expense. It will appear in the memorandum JV account, that's true. But as I told you, memorandum JV account, you don't pass a double entry. So what is a double entry that you will pass here? Okay, see, you will debit bank account for the money that comes in, and you will debit JV with Y account in the books of X, and you will credit bills receivable because it is gone out. Okay, so the discount charges on discounting of bills receivable accepted by Y, and in the books of X where he is maintaining only his own transactions, will be debited to JV with Y account. On supply of goods out of own stock for joint venture business. Okay, so here entry will be joint venture account debit to purchases account, whatever be the method, right? I mean, whether it is whether they are maintaining separate books of accounts or whether they are recording all transactions, uh, purchases account will be credited and uh, JV account will be debited. So answer is B, purchases account, right? Okay, so A and B enter into a joint venture sharing profits and losses equally. A purchased 200 kg of rice at rupees 20 per kg. Brokerage paid is rupees 400. Carriage paid is rupees 600. B sold 90% goods at rupees 22 per kg. Balance rice was taken over by B at cost less 20%. Okay, the value of rice taken over to be recorded in the JV account will be how much? Okay, so here I told you that when an asset or whenever the stock is being taken over by one of the co-venturers, that has to be put to the credit. Okay, that has to be placed to the credit of the joint venture account. So the entry will be debiting the co-venturer account and crediting the JV account. Okay, so I'm sorry. So let's see how to calculate this. So here it's a fairly simple problem, but what we need to keep in mind is this: brokerage paid and carriage paid. So while valuing the stock, we need to take into account these expenses also. And we'll have to just recollect what we learned in the consignment, right? And we'll have to take proportionate uh, cost while valuing the remaining rice that is being taken over by B, right? So let's see how this is to be done. So we know that, okay, cost per kg is 20 rupees, right? This is given to us, and A has incurred a total of 1000 rupees. Okay, that is 400 plus 600 in order to get it transported to B. Okay, and this 1000 rupees has been incurred on 200 kgs. So the cost per kg is rupees 5, right? This is our first finding. Next finding is we have to find out how much is unsold. We know that B has sold 90% of 200 kgs, which means he has sold 180 kgs. So what is remaining? Remaining is 20 kgs, right? So this is a second finding. We need to value this 20 kgs. See, cost per kg now is the purchase cost of 20 plus the expenses, proportionate share of expenses 25. But what is the value at which B is taking it? It is not at 100%. He is taking it at 25% less 20% of 25%, 25 rupees. Sorry, it's 25 rupees less 20% of 25 rupees, which is 20. So he's taking it over at 20. Okay, this is our third finding. Okay, so now how will we value the stock? There are 20 kgs valued at 20. So the value of stock is 400 rupees. This is the answer. Clear? Right. So let's go back. So the answer is B, 400 rupees. Right. So if you take 20 rupees as the cost and you ignore the expenses and you reduce 20% from 20 rupees, we'll get 16 rupees. If you value 20 at 16, you'll get 320. So one of the options will still be right and you'll be really happy that you got the answer right, but in fact you'll be losing 0.25 because that's the wrong answer. The only catch in this problem is we need to consider the expenses that have been incurred by A in order to transport the goods to B's location. Right. Okay. Now we'll go to the next question. It's a simple arithmetic question here. It says A and B enter into a JV sharing profits and losses equally. A purchased 10,000 kgs of rice at rupees 50 per kg. B purchased 2000 kgs of wheat at rupees 60 per kg. A sold 2000 kg of wheat at 70 per kg and B sold 10,000 kg of rice at rupees 60 per kg. What is the profit on joint venture? It's a very simple basic arithmetic problem. Nothing but income minus expense. Do we have to again here whatever is purchased has been sold, so there's no question of taking over, right? So it's very simple. The total cost of purchase is 10,000 into 50 plus 2,000 into 60. Okay, right? So the total cost is, so cost of purchase is 10,000 into 50 plus 2,000 into 60. Okay, so this is 5 lakhs plus lakh and 20 . Sales is 2,000 into 70 plus 10,000 into 60. Okay, so it's lakh and 40 plus 6 lakhs, which is 7 lakh 40. So profit we know is cost minus, sorry, sales minus cost, so it is lakh and 20,000 rupees. Simple problem, something that we would have done in class 5 or 6. Okay, so answer is lakh and 20. Next, same information is given to us, right, and they are asking us to find out what is the final remittance when same set of books is maintained. Okay, so we know, see, what we need to remember is that when such questions are asked, okay, suppose the question, this information comes to you in the exam and the question is find out the final remittance, that's all. Your first step should be to find out the profit. Okay, so we've just found out the profit as lakh and 20, and we know that A and B are sharing profits and losses equally, so A gets 60 and B gets 60. Now we need to find out what is the final remittance to be made. Let us prepare the accounts in the books of A. Okay, so we are now using method 2 to prepare the accounts in the books of A, where all the transactions relating to the JV are recorded in A's books. Okay, so two accounts will be opened. First, A will open a JV account and he will open B's account. Okay, now let's look at the transactions. What's happening first? A is purchasing 10,000 kgs of rice at 50 per kg. So entry will be JV account debit to cash. Okay, so this will be 10,000 kg into 50 rupees, right? So that will be 5 lakhs. Next, B is purchasing 2000 kgs of wheat at 60 per kg. So the entry will be JV account debit to B. He is purchasing 2000 kgs of wheat at 60 rupees, so it's 1.2 lakhs. So in B's account, you have to immediately credit him by passing by JV account 1.2 lakhs. Okay. Next, now what's happening? A is selling 2000 kgs of wheat at 70 per kg. So by cash, this is for the sale that A has made. 2000 kgs are sold at 70 rupees, so 1.4 lakhs. Then what happens? B is selling 10,000 kgs, so entry will be B account debit to JV. So by B's account, he's selling the 10,000 kgs at 60 rupees, so 6 lakhs, right? So now let's debit B's account to JV 6 lakhs. Clear? Now the profit will be to profit on JV. So A's profit will go to his P&L account and B's profit will be, we'll pass the entry JV account debit to B's account. We know it is 60,000 each, 0.6 lakhs. Okay, now B's account has to be credited by JV. It will be 0.6 lakhs. So now the balancing figure in B's account will tell us how much money B has to remit to A. It will be 4.2 lakhs. Let's okay, it's not 4.8, it is 4. Let me just strike it off. 4.2 lakhs by bank. Okay, so B has to remit 4.2 lakhs to A. Now let's go to the next question. Question number 15. A and B were partners in a joint venture, sharing profits and losses in the proportion of 4/5 and 1/5 respectively. A supplies goods to the value of rupees 1 lakh and incurs expenses amounting to 10,800 rupees. B supplies goods to the value of rupees 28,000 and his expense amounts to rupees 1,600. B sells goods on behalf of the joint venture and realizes 1,84,000 rupees. B is entitled to a commission of 5% on sales. B settles his account by bank draft. What will be the final remittance, right? So here, as I told you, the question is what is the final remittance, and here we know that B has to remit to A because he is making the sale in the joint venture, so he has the money and he has to remit to A. That's clear. But what is our first step? First step is to find out the profit on JV. So let's open the JV account. So now we are accounting the books of A, accounting in the books of A. Okay, so first step is to find out the profit or loss on JV, for which we are going to open the JV account, right? Now let's trace all the transactions, and then there'll be another account which is called B's account, which will record all transactions relating to B in the JV. First is A has supplied goods to the value of rupees 1 lakh, right? So entry will be JV account debit to purchases 1 lakh. Some expenses have been incurred to bank 10,800 rupees. Next, now B has supplied some goods. Okay, so entry will be JV account debit to B 28. Okay, and B has also incurred some expenses of, so again to B, or okay, 1600. So now go to B's account and credit him, let's say JV account, we will total it up and say 29,600. Okay, now what's happening? Okay, he realizes like no, B is selling the goods, so B account debit to JV is the entry, lakh and 84 to JV, lakh and 84, and B is entitled to get a commission of 5% on sales. So entry again will be JV to B, commission is 5%, so it's 9,200. 5% of lakh and 84, 5% of 184,000 is 9,200. So by JV 9,200. Okay, so that's it. Now let's find out the profit on JV. This will give us the profit on JV. So A's share will go to his P&L account and B's share will be credited to B's account. So let's find out the profit. Profit will be lakh and 84 minus 1 lakh minus 10,800 minus 29,600 minus 9,200. 34,400 is the profit. Okay, 34. The total profit is 34,400, and that which will be credited to A's P&L account will be their sharing in the ratio 4/5 and 1/5. So divided by 5 into 4 is 27,520, and 6,880 will go to B. Okay, so by JV we will credit B with his share of profit, and this will give us the money that B has to remit to A. Okay, it'll be lakh and 84 minus 29,600 minus 9,200 minus 6,880, which is 138,320. Right, never forget the commas. Right, so the answer is A. B will remit 138,320 to A. Right. Okay, so 16th question is the same information is given to us and they are asking us to find out what is the profit, which we've already computed, otherwise we wouldn't have been able to complete the previous problem. The answer is 34,400. Right. Next, in a joint venture, A contributes 10,000, B contributes 20,000. Goods are purchased for 22,400. Expenses amount to 1,600. Sales amount to 28,000. The remaining goods were taken by B at an agreed price of rupees 800. A and B share profit and losses in the ratio of 1:2 respectively. As a final settlement, how much will A receive? Okay, so here again, our first step is to find out the profit. Right, let's find out the profit. Just open the JV account. Right, so it's a simple problem. JV account, right, goods are purchased for 22,400, so two purchases 22,400. Right, expenses is 1,600. So we don't know who has incurred these expenses, right? So let us just list out. All we need to do is find out the profits. So let us just list out all the expenses on the debit side and the incomes and the amount taken over on the credit side. So sales is 28,000. Goods are taken over by B at an agreed price of 800. Okay, so this is going to give us the profit. So we have 28,800 as the total. So 28,800 minus 22,400 minus 1,600, right? So the profit is 4,800. This is shared in the ratio of 1:3. So A gets 1,600, B gets 3,200. They're asking you how much will A receive as the final settlement. See, we know that A has contributed 10,000 rupees. So he obviously want to take back the money that he has put in. And in addition, the JB has made a profit of 1,600. So he'll take back 11,600. Okay. So the answer is A. Next. A and B enter into a JV by opening a joint bank account, contributing rupees 20 lakhs. Profit sharing ratio between A and B is 3:2. How much is to be contributed by A? See, it's not necessary. Oh, sorry. So 3:2. So we know that A has to contribute 3 by 5 of 20 lakhs, which is 12 lakhs. A, B, and C are co-venturers. The relative profit sharing ratio between A and B is 3:2. Between B and C is also 3:2. Find out the profit sharing ratio between A, B, and C. See, such problems, what we should do is we should use the method of intelligent guessing and the process of elimination of the four options. First option is 3:2:2. We know that between A and B ratio is 3:2. Between B and C it is also 3:2. Now let's look at the first option, A. It says 3:2. Between A and B 3:2 is correct. But between B and C it is 2:2 or it is 1:1. So we can straight away rule out A. Next come to option B. It is 9:6:4. Right. Between A and B it is 9:6, which is nothing but 3:2. Between B and C it is 6:4, which is nothing but 3:2. So the answer is B. Right. So when there are such problems, there's no point in spending time in trying to solve and arriving at the answer on your own. You can do that, but the fastest and the smartest way of tackling such problems is by way of the process of elimination. Okay, by looking at certain options we can straight away eliminate them, and we can zero in on the correct answer. Next, come to problem number 20. A and B entered into a JV. They opened a joint bank account by contributing rupees 4 lakhs each. The expenses incurred on venture is exactly equal to 4 lakhs. Once the work is complete, contract money received by check is rupees 4 lakhs. In shares, it's rupees 1 lakh. The shares are sold for 80,000 rupees. What is the profit on the venture? Okay. So here we can just do it in our mind, right? See here, the money received on the contract is 5 lakhs plus 1. We are getting 5 lakhs, 4 lakhs plus 1, 5 lakhs. Expenses incurred is 40,000 rupees, right? Which means the profit made is 1 lakh. 5 lakhs minus 4 lakhs is 1 lakh. But what's happening? The shares of 1 lakh are immediately sold for 80,000, where we are making a loss of 20,000 rupees. So the profit that's made in the venture is 1 lakh minus 20,000, 80,000. Okay, so the answer is B, 80,000 rupees. Next, A and B enter into a JV for purchase and sale of typewriter. A purchased a typewriter costing rupees 2 lakhs, repaired it for 20,000, incurred some other expenses for 20,000. B has sold it at a 20% margin on selling price. What is the sales value? So here there's nothing that's testing you on the knowledge on joint venture. It's again a simple arithmetic problem. The total cost incurred is 2,40,000. We know that 1 by 5 on selling price is 1 by 4 on cost. So 2,40,000 into 1 by 4 is 60,000 is the profit. So the sale value will be 2,40,000 plus 60 is 3 lakhs. Right? So the answer is B. Right. We come to question number 22. Goods costing rupees 10,000 are taken over by X at 20% less, which means X is taking them over at rupees 8,000, and so 8,000 has to be credited to the joint venture account. Next, goods costing rupees 10,000 have been destroyed in an accident. Insurance claim is nil. We are not getting any money from the insurance company, and hence nothing has to be credited. No entry we need to pass. Nothing will be credited to the books of the joint venture, the books of the co-venturers. Goods costing 10,000 have been destroyed in an accident. Insurance company paid 80%, which means they have received 8,000 rupees from the insurance company, and so 8,000 rupees will be credited to the joint venture account. Right? So with this we come to the end of our discussion on accounting for joint venture. In case you have doubts, please feel free to mail me at queries@greymatteracademics.com. And so until next time, goodbye.